Welcome to Iron Financial. I am your lead analyst, and as always, I'm joined by our resident market skeptic. Today we are placing one of the most complex, heavily debated corporate turnarounds of the decade directly onto the anvil. We're tearing into Intel's corporation's second quarter 2026 earnings report and forward outlook. Our entire mission here is to help you forge a stronger portfolio, cut right through the deafening market noise, and figure out if the structural integrity of this semiconductor giant is actually holding up under some truly immense heat. Are we witnessing the greatest manufacturing renaissance of the century, or is this just a massive high-capex illusion? Let's fire up the furnace and jump right into the single most glaring contradiction of this entire quarter.
Yeah, let me jump in right here with my hammer ready, because you look at the headlines for this quarter and your jaw just hits the floor. We are seeing contradictory numbers that make absolutely zero sense at first glance. On one hand, executive management is taking this massive victory lap, cheering about unprecedented market demand and operational beats across the board. But then, on the exact same earnings release, there is a gaping $11 billion crater sitting right there in the net income line. How in the world does a company post its fastest revenue growth in 15 years, absolutely crush Wall Street expectations, and yet still report an $11 billion quarterly loss? Seriously, how are these numbers not just accounting acrobatics, masking a structurally broken core? We need to know if this is real operational growth or just financial smoke and mirrors.
That is exactly the right question to ask. But to understand why that terrifying loss isn't actually a fatal crack in the armor, we first have to look at the sheer undeniable force of their top-line beat. Here is the unvarnished operational reality of the business right now. Intel posted a massive $16.1 billion in net revenue for Q2 2026. That is up an incredible 25% year over year. To put that kind of heat into perspective, the Wall Street consensus was sitting way down at around $14.4 billion. Even Intel's own high-end guidance was capped at $14.8 billion. So they didn't just beat expectations, they absolutely obliterated them. And here's the kicker. They did it with a remarkably strong 41.8% non-GAAP gross margin. That margin is up 12.1 percentage points from this exact same time last year, exceeding their own internal guidance by a full 280 basis points. Beating consensus by almost $2 billion is incredibly heavy lifting, and a gross margin nearing 42% proves they have some serious pricing power returning to their product stack.
Wait. You can talk about the top line all you want, but you cannot just forge a beautiful exterior and ignore the floor completely falling out from underneath. There is a GAAP net loss of a staggering $11.0 billion on the books. That translates to a brutal loss of $2.16 per share. Yet somehow, management's non-GAAP net income is magically a positive $2.2 billion, coming in at 42 cents a share. And keep in mind, the consensus estimate for earnings per share was just 21 to 22 cents, with guidance at 20 cents. So how exactly do you reconcile a $2.2 billion operating win with an $11 billion net hemorrhage? We need to demystify these dense financial footnotes right now.
Fair point. Let's break down the footnotes. It all comes down to a highly specific, very unusual accounting item called escrowed shares. Right, so back in 2025, under the CHIPS Act Secure Enclave Agreement, the U.S. Department of Commerce took roughly a 9.9% equity stake in Intel. The entry price for those escrowed shares was pegged right around $20.47 a share. Now, here is where GAAP accounting rules force a massive, almost comical distortion. Intel is legally required to revalue this obligation every single quarter based on the current market price of its own stock. Paradoxically, because Intel's operational turnaround is actually working and their stock price surged way past that $20.47 government entry point, the paper value of what they owe the government ballooned. It is strictly a mark-to-market quarterly revaluation. It does not drain a single cent of operational cash. Nothing about the underlying business got worse. In fact, it was the exact opposite.
Okay, let me look at the exact math here. So they had $2.2 billion in non-GAAP net income, but GAAP rules forced them to book a $12.53 billion mark-to-market accounting charge for those escrowed shares. You subtract that non-cash charge, and boom, you get your $11.0 billion GAAP net loss. Okay, I'll concede. Smelting out this $12.53 billion non-operational non-cash debt proves the core business isn't actually bleeding out. The foundation isn't cracked by a paper liability. But look, if we strip away the accounting quirks, we still need to know what is actually driving that $16.1 billion in real revenue. We have to stress test the internal segments to see if all divisions are pulling their weight or if one segment is carrying the entire factory on its back.
Let's do exactly that. Moving into our first major section, heavy lifting segment breakdown. We're heading straight to the manufacturing floor to stress test the internal segments and see exactly which divisions are forging the real revenue and operating profit.
The revenue growth across the company was definitely not evenly spread out. The data center and AI segment, DCAI, did some serious heavy lifting here, pulling in $6.3 billion in revenue. That is a jaw-dropping 59% year-over-year growth, officially making it their strongest year-over-year growth on record for that division. It was driven incredibly aggressively by massive market demand for their new Xeon 6 processor line and custom ASICs. Meanwhile, client computing grew a very solid 13% to $8.9 billion, and the total Intel Foundry revenue came in at $5.8 billion, which is up 31%. A 59% jump in the data center is undeniable. That's huge. But honestly, revenue is just top-line vanity if you can't keep your costs under control, especially against rising input costs like memory and advanced packaging substrates. Are they actually making money on this?
The structural integrity of their margins is actually rock solid right now. That data center segment didn't just grow the top line, it threw off $2.5 billion in pure operating profit. That represents a massive 40% operating margin for DCAI. Now, you might be wondering how on earth they achieve a 40% margin in a highly competitive, cutthroat hardware business. Well, they are proving that the CPU is absolutely not dead in the AI era. This CPU reemergence in AI orchestration, coupled with the rollout of the Ethernet E835 portfolio, but scales up to a blistering 200 gigabits, shows they are capturing the high-margin networking and compute infrastructure. This isn't just selling cheap silicone. This is premium high-heat metallurgy.
And let's not ignore the traditional bedrock of the company. Client computing and physical AI brought in a very healthy $8.9 billion in revenue. The big catalyst here was the late 2025 release of the Core Ultra Series 3 AI PCs, along with rapidly growing traction in robotics. Consumers and enterprises are actually buying these units. They're currently powering over 200 designs from leading global partners. It's literally the most broadly adopted AI PC platform Intel has ever delivered. This proves broad global adoption and establishes a hardened foundation of 13% growth in what is otherwise a notoriously mature cyclical PC market.
Fine, the product side is performing. But we have to scrutinize the actual Foundry, the third-party manufacturing business. They report $5.8 billion in total Foundry revenue, but a massive chunk of that is still just Intel selling wafers to itself. The external Foundry business is still in its absolute infancy. Look at the numbers. External customer revenue is at $293 million. Yes, it's growing fast, up 68% quarter over quarter, but it's still a tiny fraction of total operations. And the operating loss for the Foundry as a whole only narrowed slightly, moving from a $2.4 billion loss down to a $2.1 billion loss. They're still burning intense cash trying to become the Western alternative to TSMC.
You're right, it's cash intensive. But remember, building a world-class foundry isn't a quarterly project. It is a multi-year forging process. The key metric isn't today's external revenue, it's the execution on the future process nodes that will attract the massive clients tomorrow.
Which brings us perfectly to our next major section, forging the future nodes. The entire turnaround thesis and the ultimate justification for billions in operating losses in the Foundry segment rests completely on whether management can actually execute on the manufacturing floor.
We really need to anchor these abstract financial numbers in physical reality. Intel isn't just moving numbers on a spreadsheet. They are pouring thousands of tons of concrete and installing the most complex machinery ever created by humans. Management explicitly stated that their volume upside this quarter was driven by higher factory yields and significantly improved cycle times. They also just announced a massive €5 billion investment to expand manufacturing capacity. They are aggressively scaling up cleanroom space, deploying advanced packaging expansions, and securing the most advanced lithography equipment on the planet.
But all of that is just corporate poetry if we don't have concrete timelines. Did they actually hit their node targets, or is management just selling empty hype while burning through investor cash?
They are hitting the targets dead on. In Q2 2026, the highly anticipated advanced Intel 18AP node officially entered risk production, meeting the exact timelines shared with customers way back last year. They have also entered high-volume manufacturing for a subset of the Panther Lake processors using ASML's XeNA high EUV technology. This is a monumental milestone. High EUV is the absolute cutting edge of lithography, allowing for incredibly dense transistor packing. And they aren't stopping there to take a breath. They are already deep into developing the future Intel 14A node, which utilizes next-generation RibbonFET and PowerDirect innovations, promising a 15 to 20% boost in performance per watt. Market skeptic? Okay, but if you build it, will they actually come? You don't buy $250 million high-NA EUV machines just for fun. Who is actually buying this expanded capacity? They are securing the exact external partnerships needed to validate the Foundry model. Just recently, they announced a major strategic collaboration with Fortinet to develop the Fortinet Security Processor 6 using Intel's advanced design, packaging, and manufacturing. They are also co-developing industry-specific AI and compute solutions with heavy hitters like Foxconn, Siemens, Hitachi, and Greenstone Biosciences. And keep in mind, this is all on top of their existing external engagements, which includes a massive unnamed cloud provider, a deep collaboration with SambaNova, and the TerraFab initiative, which pulls in huge players like SpaceX, xAI, and Tesla. They are forging real, purpose-built silicon partnerships that absolutely demand this cutting-edge capacity.
All right, let's move to the next section, the capital allocation stress test. Because all of this, the clean rooms, the massive ASML machines, the new advanced substrates, it requires an almost apocalyptic amount of cash. Can Intel actually afford the massive capital expenditures required to fuel this roadmap without their financial foundations completely cracking? To answer that, you just have to look at the sheer liquid strength they generated this quarter. In Q2 2026 alone, Intel generated a staggering $7.0 billion in operating cash flow. The operational side of the business, selling highly profitable chips to data centers and PC makers, is throwing off so much cash that it acts as the necessary fuel for this massive foundry buildout. They have the liquid strength to absorb the intense heat of this manufacturing scale-up. This cash generation also allows them to manage incredibly complex strategic moves and debt management, like the $14.2 billion joint investment buyback they just seamlessly executed for Fab 34 over in Ireland. And that financial momentum carries directly into their Q3 2026 forward outlook. They anticipate revenue landing between $15.8 and $16.8 billion for the upcoming quarter. They expect non-GAAP gross margins to hold incredibly stable at an impressive 42.0%, and they project a non-GAAP EPS of 38 cents. The baseline operational business is showing really strong predictability right now, providing a solid, stable floor for the massive investments happening above it.
That stable floor is great, but maintaining this momentum requires relentlessly smelting cash into equipment and substrates. Intel has officially raised their capital expenditures to over $20 billion for 2026. Let's talk about the stock action because it was wild. This heavy AI capex burden is exactly why the market reaction to this earnings report was so incredibly volatile. During regular trading hours, leading right up to the print, the stock actually fell 2.3%. Traders were nervous. Then, boom, the earnings drop, and that massive revenue beat hits the wire. The stock violently spikes 12 to 13% in post-market trading, but then it just bled those gains right back. The market is terrified of this heavy capex burden and general macro tailwinds, constantly weighing them against the very real risks of supply constraints. It is a major ongoing stress test, and honestly, it's really hard for short-term traders to properly value a decade-long manufacturing turnaround.
Exactly. It's a long game. Which brings us to our final section. The final verdict. We've synthesized the dense financial footnotes. We've completely stripped away the $11 billion paper loss to reveal the true operational beat, and we've stress-tested the heavy capex requirements against their surging cash flow.
Here is the reality. The core business is incredibly strong, margins are up, and the data center growth is nothing short of explosive. Market skeptic. But the foundry is still a cash-hungry beast that desperately needs to prove it can land even more external whales to justify the spend. So we leave you with this. Are you looking at a company forging an unbreakable long-term foundry empire that will truly rival TSMC? Or are investors walking blindly into a high capex trap? The operational numbers from Q2 strongly suggest the foundation is rapidly solidifying, but the intense heat of $20 billion in capex will absolutely test their mettle. We want to hear what you think. Make sure to cut through the market noise, subscribe to Iron Financial for more deep dives, and we will see you on the next earnings print. Stay forged.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.